Warren Buffett's investing tip number 7: stay patient and disciplined. The importance of patience and discipline. Long-term perspective. Warren Buffett emphasizes the importance of a long-term investment perspective. Patience allows investors to ride out market volatility and benefit from the compounding growth of their investments over time. Avoiding impulsive decisions. Discipline helps investors avoid making impulsive decisions based on short-term market fluctuations, news, or emotions. Sticking to a well-thought-out investment strategy prevents hasty actions that can lead to losses. Long-term commitment. Commit to holding investments for the long term, ideally several years or even decades. This aligns with Buffett's philosophy of buying quality businesses and holding them indefinitely. Ignore short-term noise. Focus on the fundamentals of the business rather than short-term market movements or media headlines. This helps maintain a steady course without getting distracted by temporary market conditions. Adherence to investment principles. Stick to criteria. Develop a set of investment criteria based on thorough research and analysis, and stick to them. This might include valuation metrics, business quality, management integrity, and financial health. Avoid speculation. Steer clear of speculative investments or trends that don't align with your investment principles. Speculation often leads to higher risk and can disrupt disciplined investing. Emotional control. Fear and greed. Recognize and manage emotions like fear and greed, which can drive irrational investment decisions. Fear can cause panic selling, while greed can lead to overpaying for investments. Confidence in strategy. Trust in your investment strategy and the research behind it. Confidence helps maintain discipline, especially during market downturns or periods of uncertainty. Regular review and reflection. Periodic assessment. Regularly review your investment portfolio and strategy to ensure they align with your goals. This helps in making necessary adjustments while avoiding reactionary changes. Learning from mistakes. Reflect on past investment decisions to learn from mistakes and successes. This continuous learning process improves decision-making and reinforces disciplined investing. Practical applications. Developing a strategy. Clear goals. Define your investment goals, risk tolerance, and time horizon. Having clear goals helps maintain focus and discipline in achieving them. Investment plan. Create a detailed investment plan outlining your criteria for selecting investments, asset allocation, and diversification. A well-structured plan acts as a roadmap and reinforces disciplined decision-making. Sticking to fundamentals. Quality over quantity. Focus on investing in high-quality businesses with strong fundamentals rather than chasing high numbers of investments. Quality investments are more likely to yield positive long-term returns. Valuation discipline. Be disciplined about the prices you are willing to pay for investments. Avoid overpaying by adhering to your valuation criteria and waiting for opportunities that meet your standards. Handling market volatility. Resilience during downturns. During market downturns, maintain your composure and stick to your investment strategy. Avoid panic selling and consider downturns as potential buying opportunities if valuations become attractive. Regular contributions. If applicable, continue to invest regularly, regardless of market conditions. This practice, known as dollar-cost averaging, can help smooth out market volatility over time. Case studies and examples. Buffett's investment in Coca-Cola. In the late 1980s, Buffett invested in Coca-Cola when the market sentiment was negative, and the stock was undervalued. His patience and discipline in holding the stock for the long term paid off as Coca-Cola's value grew significantly over the years. Berkshire Hathaway's acquisition strategy. Buffett often waits patiently for the right opportunities to acquire businesses at attractive prices. His disciplined approach to acquisitions ensures that he only invests in companies with strong fundamentals and fair valuations. Market timing. Buffett advises against trying to time the market. Instead, he focuses on the intrinsic value of businesses and waits patiently for the right moment to invest. This disciplined approach has proven successful over his long investment career. Building patience and discipline. Mindset and philosophy. Value investing. Embrace the value investing philosophy, which focuses on buying undervalued securities and holding them for the long term. This mindset aligns with Buffett's principles and encourages patience and discipline. Learning from masters. Study the investment philosophies and practices of successful investors like Buffett, Benjamin Graham, and Charlie Munger. Their wisdom and experience can provide valuable insights and reinforce disciplined investing. Continuous improvement. Education and research. Continuously educate yourself about investing, market trends, and economic principles. Staying informed helps in making better investment decisions and maintaining discipline. Peer discussions. Engage in discussions with other investors or join investment clubs to exchange ideas and perspectives. Collaborative learning can reinforce disciplined practices and provide support during challenging times. Personal development. Patience practice. Cultivate patience through mindfulness practices, meditation, or other techniques that help you stay calm and focused. Developing patience in other areas of life can positively impact your investment behavior. Setting realistic expectations. Set realistic expectations for investment returns and timelines. Understanding that building wealth through investing is a gradual process helps maintain patience and discipline. By staying patient and disciplined, investors can navigate market volatility, avoid costly mistakes, and achieve long-term success. This principle, central to Warren Buffett's investment philosophy, emphasizes the importance of a steady, informed, and rational approach to investing. Click the link below for more investing tips.